In this session, we will focus on the understanding of the Black-Scholes Merton model, which is one of the most popular option pricing models, right? Of the two highly popular ones, one is the binomial tree-based models, and the second one comes out to be the Black-Scholes Merton model. So it's essential that we understand what went into it, what is this model all about. So as a part of this session, I thought I should be covering first of all the log normal property of stock prices, the stock prices behaving or showing log normal distribution. Then based on that, trying to understand what is the distribution for rate of returns, and we'll have a small discussion on the expected return and the volatility, which are the two important factors of associated with any return. Then the basic idea underlying the Black-Scholes Merton differential equation. We'll do a derivation of the Black-Scholes Merton differential equation, then try to understand risk neutral valuation and come out with the formulas which are used by Black-Scholes Merton for pricing the options. And in that formula, we have used cumulative normal distribution functions called ND1 and ND2. So we'll try to understand what they are. Then a slight difference with respect to warrants and employee stock options. And towards the end, we'll spend some time on the implied volatilities and how does an option price change in the presence of dividend. So these are the various elements that go into our agenda for this session. So before we get started, something about the Black-Scholes Merton model. It's a major breakthrough in pricing the European stock options. Even today, this is the model which is heavily used to price the option. And it has a lot of influence even today in the way the traders are looking into the pricing, the hedging of the derivatives. Of course, within this, we are looking at two different groups, Black and Scholes together and Merton separately. Here, both of them, they tried looking at the relationship between the market's required return on the option and the required return on the stock. So Black and Scholes have used the capital asset pricing model, whereas Merton was more involved in setting up a riskless portfolio containing the option and the underlying stock. So both of them finally led to the similar kind of a solution, which targeted towards pricing the option. The way they looked at is the approach of both of them is different, but the end result which both of them have got out, both the teams have got out, is into a model which can be used for pricing the option. Now, first looking at the log normal property of the stock prices. One of the major assumptions that has gone into the Black-Scholes Merton model, it is making an assumption that the percentage changes in the stock price, not the absolute. The percentage change in the stock price for a very short period of time delta t, it is normally distributed, which means this is the relation. Delta S by S, which is a percentage change in the stock price, it is normally distributed with some mu times delta t and sigma squared times delta t. Now, once I am using this, we know that from this I can very well talk about the log ST is following See here it means log ST minus log S0. It will follow if I go with the differential equation part. Right, if I go with the differential equation part and try to solve using the Ito's lemma, we can very well prove that log st minus log s0 is going to be a normally distributed one with mu minus sigma squared by 2 times t and a variance of sigma squared t, and log st is also normally distributed with log s naught plus mu minus sigma squared by 2 times t sigma squared t. So that is what we are assuming as log st is following a normal, means st will follow a log normal distribution. Right. Now let's look at one simple numerical. Consider a stock with an initial price of 40. Right. So initial price S0 is 40. The expected return is 16% per annum. The volatility is 20% per annum. Find the 95% confidence interval of the stock after 6 months. Now if I am going with that, assuming this property, so for me log ST after 6 months has to follow a normal distribution with log S0, which is log 40, which is the current price, plus mu 16% minus sigma squared 20% squared by 2 times t is 0.5 and a variance of sigma squared t. So let's try to put this numbers into a spreadsheet so that we can try understanding the stuff. Okay, so let's take this. S naught is 40, mu is around 16%, sigma is around 20%. Now if I have to look at log ST, right, log ST will follow a normal distribution with mu log S naught plus mu minus sigma squared by 2 times t. So the mean of log ST is log S0 plus mu minus sigma squared by 2 times t is 0.5. So this happens to be the mean. So let me take it, 3.76 is the mean. Similarly, I am looking at the variance of log ST. What is the variance of log ST? I'll get it as sigma squared t. So sigma squared times t is 0.5. So this is a smaller value, 0.02. So the standard deviation of log ST is going to be the square root of the above one, so 0.14. Now I can talk about 95% confidence interval for log ST, which comes out as mean plus or minus 1.96 times the standard deviation. So it comes out as mean minus 1.96 times the standard deviation, which is the lower limit. Mean plus 1.96 times the standard deviation comes out as the higher limit. And based on these two, so this is for log ST. So I can very well convert it back. 95% confidence interval for ST is nothing but I am going back to e power, saying 32.5 here and probably 56.6 here. So I am 95, I have a 95% confidence that the stock price 6 months later is going to be anywhere between 32.5 and 56.6. So this is the way we are using the log normal property of the stock prices. And as a log normal distribution, we understand that it can take any value between 0 and infinite. And it's not a normal, so it's not symmetric. It's a skewed distribution, as we are seeing. So the mean, median, mode generally are different. You find this to be the mode. The mean will be somewhere here, and the median will be somewhere in the middle. So to a large extent, you will find in this kind of a distribution, mean is greater than the median, which in most of the cases will be greater than the mode as well. And if I am looking at the expected value of ST, it comes out. If I am looking at the expected value of ST, it is nothing but S0 times e to the power of mu t. So if you are looking at the expected value of ST, expected value of ST, you will get it as S0 times e to the power of mu t. So the expected value comes to around 43.3, and the variance of ST comes out to S0 squared e power 2 mu t times e power sigma squared t minus 1, which is nothing but, if you look at it, if you try to look at it, mu is S0 e power mu t. Take the square of it, S0 squared e power 2 mu t. So this is actually becoming expectation of ST squared times e power sigma squared t minus 1. Either you can remember it in this way also. So the variance of ST, I am getting it as so mean whatever I have got, the square of it. So this is the mean that I have got, so I am taking the square of it. I am multiplying it with e power sigma squared t minus 1. E power sigma squared t minus 1. So this is working out that this is the variance in this. So I take the square root of it, works out to be my standard deviation. So just like that, consider a stock where the current price is 20, expected return is 20%. So find the expected stock price and variance 1 year from now. We have already got that situation. The expected stock price we have, for a different numerical we have already taken. S0 e to the power of mu t, then S0 squared e to the power of 2 mu t e to the power of sigma squared t minus 1 is giving me the expected stock price as well as the variance t periods from now using the log normal property of the stock prices, right? Then the next topic which we would move on is the distribution of the rate of return, right? The log normal property for the stock prices which we have used, it is very much important to provide the information on the probability distribution of the rate of return earned on a stock. So we are looking at a continuously compounded rate of return per annum. So if I am saying it is X, we are very much saying the final price is initial price S0 times e to the power of xt, which means I can very well say st by S0 is equal to e to the power of xt, and from xt it is log st by S0, and x comes out as 1 by t times log st by S0. Now if you remember, log st by S0 follows a normal distribution, right? So that's where we say x follows a normal distribution, because log st by S0 follows a normal distribution mu minus sigma squared by 2 times t sigma squared t. Now if I do x, so it has to go with 1 by t, and even here I have to take it as 1 by t squared. So x will follow a normal distribution with mean mu minus sigma squared by 2 and variance sigma squared by t. So the continuous return is continuously compounded rate of return is going to follow a normal distribution with a mean mu minus sigma squared by 2 and the variance sigma squared t. Right? So this is what probably as t is increasing, the variance is decreasing and the standard deviation is decreasing accordingly. Now that is where we are talking of, consider a stock with an expected return of 17% and a volatility of 20% per annum. So let's take this numerical. So when I am looking at a stock, expected return is 17% and volatility sigma is 20% per annum. Find the 95% confidence interval for the return, not for the price here. I am taking the 95% confidence interval for the return over a 3-year period. The time period is 3. So now I know that x, which is the return, is following a normal distribution with mean mu minus sigma squared by 2. Mean of a return, I'll take it as mu minus sigma squared by 2, comes out to around 15%, and variance of return goes with sigma squared by t. So this comes out as sigma squared by t. So this is the variance of the return, and obviously standard deviation of the return, if I have to take, I am taking the square root of the variance. So this works out to be my standard deviation. So I can very well talk about 95% confidence interval of the return, talking about mean minus 1.96 times the standard deviation to mean plus 1.96 times the standard deviation, resulting in within 3 years the return could 95% confidence interval of the return is any number between minus 7.63% to 37.63%. So that is what could be understood on the distribution of the rate of return in this example. Right? Now, we'll try to understand expected return, which we have been talking of for quite a while. Right? Expected return depends on the riskiness of the stock. So the higher is the risk, I expect a higher return. And at the same time, the expected return also depends on the level of interest rates in the economy. If the interest rates are much higher, obviously the risk-free rate is much higher. So any kind of expectation for a risky security would be much higher than that particular base risk-free rate of return. So if the interest rates in the economy are higher, it's a very common expectation for the higher return on any given security. Now we already know that the value of a stock option, when we are expressing in terms of the value of the underlying, it does not depend on expected return at all. If I am looking at the value of the stock option, we'll look at the formula for it at a later point. We will see that it is not depending on the expected return at all. In the pricing formula, we will not find mu at all in the pricing formula, which we talk about as the Black-Scholes. So the expected return does not reflect in the value of the stock option. But when we talk about the continuously compounded return, we talk about, we have already looked at in the previous slide, that x is 1 by t times this, which means the expected value of x comes out as mu minus sigma squared by 2. So this is some basic stuff about the expected return that we need to be comfortable with. Then when we go towards the volatility, it's a measure of uncertainty about the returns provided by the stock. So it's not a fixed return. So there is some level of uncertainty regarding the returns that are provided by the stock. So in general, whenever we talk about volatility, it is the standard deviation of the returns in 1 year. And the returns are expressed using the continuous compounding kind of mechanism. When I am expressing the returns in terms of continuous compounding kind of a mechanism, that is what we are calling as the volatility. For example, if I take the prices, let me just take out a spreadsheet. Now, let's say I have taken the data of the BSE Sensex index right from 1st April 2014 to 31st March 2015. These are the closing values of that index. Now, what is that we are calling as the volatility? We are talking about, first of all, continuously compounded return. So when I say return here, I am taking it as continuously compounded, which means I will compute it as log S2 by S1. Okay, this is the continuously compounded daily return. Right, continuously compounded basis I am taking the returns, and for this kind of a return I am finding out the daily standard deviation. So if I say daily standard deviation, I am using some kind of a formula like the standard deviation of the returns. So this gives me the daily standard deviation. The typical formula based way of computing that is this much. Now I have the daily standard deviation, right? And we are also looking at the annual volatility, which typically comes out as, I really need to find out how many days we have taken, to 43 days. So the daily standard deviation is converted into annual by multiplying it with the square root of the total number of trading days. So I can say that the annual volatility of the Sensex, or the traditional volatility of the Sensex, is around 13.54%. This is the way we are computing the historical volatility. We are talking about the uncertainty about the future stock price increases. It approximately with the square root of the time period. That is what we have done. So we have multiplied it with the square root of the time period. Now, if we are observing from the historical data, first thing, on a daily basis I am taking the data, I am computing the returns on a continuously compounded kind of a basis like this. From there I found out the standard deviation, and whatever I am getting, I am dividing it by square root of time to get the estimate of the population standard deviation. And on the top of that, I have a standard error of this estimate, which I get by dividing the standard deviation by the square root of 2n. So the standard error of the estimate I get as standard deviation divided by square root of 242 into 243. So this much of standard error does exist in the estimate, which means I can very well talk about a 95% confidence interval of the same, which can very well be used for plus or minus in terms of the movement of the volatility over time. So more and more data I have, I get more and more accuracy, but I know that the volatility is going to change over time, and at the same time I don't want too old data for predicting the future volatility. So that is the reason generally 90 to 180 days of a data is typically taken for estimating the volatility from the historical data. Now, a few things which we have already brought out. If I have to compute the volatility per annum, we are taking the volatility per trading day. I am multiplying it with the square root of number of trading days per annum. Right? But because I don't want to take calendar days here, there have been some kind of literature that is available, some kind of research that has been done, that the volatility, the fluctuation is much higher when the market is open rather than when it is closed. So the volatilities have been much lesser for the for those days where the market is closed. So it is more and more appropriate that while computing the volatility, we take only the number of trading days per annum, right? And even when I'm doing the valuation of the option, in terms of measuring how many days to expiry for this option, even there we focus more and more of trading days rather than the calendar days. So remember, for computing the volatility, even though we first compute the daily volatility, we convert it into an annual volatility by focusing more on the trading days, not on the calendar days. And talking about what causes volatility, every time, every day, regarding a lot of stocks, there is a lot of new information that is coming into the market. Now, once the new information comes, people change their opinion. Some of them think they will buy, some of them think they will sell. So, different opinions, the valuation of the stock differs, and that is the one that is changing the volatility. That is causing the volatility. If more people think that the news is positive, there's a lot of buying that is happening. If a lot of people are pessimistic about the news, then there's a lot of selling that is happening, which will result in the stock price falling drastically. In either of the cases, the volatility is much more severe. So, to a large extent, we find that the volatility is caused by the trading itself. Now, this is where we'll slightly move towards the Black-Scholes model, the differential equation that has been identified as a Black-Scholes for the derivation of the Black-Scholes model. So it is, when I talk about the Black-Scholes Merton differential equation, this is the one that should be satisfied by the price of any derivative depending on a non-dividend paying stock. So that's the reason there is a lot of importance that is associated with it. This differential equation, not just for options, even for forwards, this differential equation needs to be satisfied. Then only I can do the pricing of any derivative. If this differential equation is not satisfied, if the equation which we are going to talk of is not going to be satisfied by any derivative product, then there is no question of pricing that particular product. That's the reason we really need to check whether this particular instrument can be priced or not, can very well be verified using the Black-Scholes Merton differential equation. Conceptually, it's more and more similar to that of a no arbitrage argument. So where we talk about setting a riskless portfolio consisting of one position in the derivative and position in the stock. If you remember, in the binomial tree version, we discussed more or less the similar kind of a stuff. I construct a riskless portfolio consisting of a position in the derivative and the position in the stock. And if it has to be a risk, if there are no arbitrage opportunities, so the return that I am getting should be a risk-free, because the final amount that I am getting, irrespective of whatever happens to the stock price, I am getting the same value of the portfolio. So which means the return that I should get there should be equal to my risk-free rate of return. And I should be able to set up the riskless portfolio quite comfortably. because I'm doing it with stock and the derivative, and both of them are getting affected by the same source of uncertainty. So there is some level of perfect correlation that is existing between the two, at least for the short period of time. There is a lot of strong correlation because both of them are affected by the same underlying, same source of uncertainty, and that's the reason there is always a chance of perfect correlation between the two instruments, and at least for a short term basis. And and also because we have set up a riskless portfolio, we are saying that at the end of that short time period, the value of the portfolio is known with certainty. But that's the difference. In the Black-Scholes Merton model, they said that the derivative position is riskless only for a very short period of time. It's not forever, which means I have to constantly change the composition of my portfolio. The portfolio needs to be adjusted, rebalanced. It is risk neutral. It's risk neutral or riskless only for a very short time period. And all these things have gone into the assumptions for the derivation of the Black-Scholes formula. So some of the key assumptions, in some cases they may be relevant, in some cases they may not. The stock price follows a geometric Brownian motion. Right? We have defined the geometric Brownian motion, where we have talked about delta S by S, or probably ds by S is our ds is going out with mu s dt plus sigma s dz. This is what is going with the geometric Brownian motion. The same logic if I am putting in a discrete form, delta s by s, which is going as mu s delta s or mu s delta t plus sigma s dz, I can write it as epsilon square root of delta t. So this is what is coming out to be the discrete version. So this is what we called as a geometric Brownian motion. The mean is mu, sigma is constant. So mu and sigma, both of them are constant. That is what the geometric Brownian motion is talking of. The short selling of the securities is possible to any extent, and whatever the short selling I am doing, I can use the full proceeds of that. No transaction costs, no taxes. All securities are perfectly divisible. Means I can create a stock, I can sell 0.5 shares of the stock, I can buy 0.23 shares. All these divisibilities are very much possible. There are no dividends, which may or may not be a realistic assumption. If it is for a very short period of time, yes, this is more realistic, but if it is a longer term option, probably it is far away from reality. No riskless arbitrage opportunities, assuming that whatever the opportunity that gets created, it is knocked off in no time. Security trading is continuous. It's not, there is no closure of the market. Right? In reality, the security market is active only during probably 7 to 8 hours on the weekdays, and other time it is closed. But this is assuming that the security trading is continuous and the risk-free rate R is constant and it is same for all maturities. In some cases, especially when I am looking at all these things from a very short time period perspective, all look more and more applicable. But the moment the time period or the life of the option changes, all these assumptions get challenged. But these are the ones that have gone in for the derivation of the Black-Scholes formula. Now, let's get into the conceptual aspect behind the derivation of the Black-Scholes differential equation. So, which is talking about the derivative's price at a general time t. Whatever this BSM differential equation, it talks about the price of a derivative at a general time t. So, if I am saying capital T is the maturity date of that derivative, the time to maturity is t minus t. And we have already said that the stock price follows a geometric Brownian motion. So I am using this relation ds equal to mu s dt plus sigma s dz. And on the top of this stock price, right, on the top of this stock price, let me take this derivation on a fresh page, right. Let's do this derivation entirely on a fresh page. That would make things more easier. So we know that the stock price we know that the stock price here follows a geometric Brownian motion, which means the ds is equal to mu s dt plus sigma s dz. Now let's talk about a call option on this particular stock. So let me call F is the price of the call option, right? Or it could be any other derivative for that matter. So we know from the Ito's lemma, F, which is a function of S and T. So I can talk about the DF using the Ito's lemma, which is nothing but dou F by dou S mu S, right? I mean, I'm talking about the dou F by dou S times mu S plus dou squared F by dou S squared, half of it, sigma squared S squared plus dou F by dou T. So this is this much times dt plus dou F by dou S sigma S dz. This is what we have got as Ito's lemma, right? We have taken dou F first derivative, multiply it with this value. Then the second derivative, half of it, multiply with the square of this value. Then dou F by dou T, so the derivative with respect to T. Similarly, the dou F by dou S, the first derivative, multiply it with this value, right? So this is what is working out as a part of DF. And in the discrete version, obviously, if these two I am taking in the discrete, the first one delta S will become mu S delta T plus sigma S delta Z. And similarly here I can take delta F. Delta F again it becomes dou F by dou S. I can talk about all this times delta T. And even this I'll call it as delta Z. So which is a change in the futures price, or probably change in the option price, or change in the stock price in a very small interval of time delta T. Now here we are talking about one portfolio to be constructed, wherein if you look at the dz term is a Wiener process, and we know that the Wiener process that is underlying the derivative as well as the stock will be the same. So which means I can plan out in such a way that I can plan my portfolio in such a way that this dz term will get completely eliminated. How can I do that? I'll take a position, right? Probably if I'm going short on the derivative, so I'll go short on the derivative. So when I'm going one unit of the derivative or one call option short, the dz term is coming out as dou F by dou S sigma S dz. Now the same logic here I want the plus dou F by dou S sigma S dz. So which means I'll definitely go with dou F by dou S number of shares. So if I'm going with dou F by dou S number of shares, obviously the positive change is dou F by dou S sigma S dz. So this together is what is the portfolio that I am creating. So I am calling the value of the portfolio as some pi. So I'll get, because I'm going one derivative, the value of the derivative we have called it as f, and because I have shorted it, it is minus f. Now that I have gone long on dou f by dou s number of shares, and the price of the share at this point is some s. So this is what is going to be the value of my derivative at this point. And now I really want to find out the change, which is the delta pi. So if I want delta pi, I am taking the which is the delta f, which is minus delta f, right? That is what I have to do, minus delta f plus dou f by dou s times delta s. Now minus delta f I know, so minus dou f by dou s mu s plus half dou squared f by dou s squared sigma squared s squared plus dou f by dou t times delta t minus dou f by dou s sigma s delta z plus dou f by dou s times delta s for me is mu s delta t plus sigma s delta z. Now what are things are getting cut off? Right, if I am looking at dou f by dou s mu s delta t, this part is going off. Similarly, sigma s dou f by dou s sigma s delta z, even this is going off. Now finally what I am left with is dou f by dou t, right, minus of dou f by dou t, or minus dou f by dou t minus half dou squared f by dou s squared sigma squared s squared times delta t. This is what I am left with as the value of the position. Now, right, this is a short position in one derivative and a long position in this. Now there is no delta z term in this at all. So because there is no uncertainty, it's like a riskless portfolio for me. And because riskless at time period delta t, so it should have earned a risk-free rate of interest itself. So what we are simply saying on the other side is, because it should earn the risk-free rate of interest itself, the delta pi I am talking of whatever is the risk-free rate of return. So this much percentage on the portfolio in this time period should what be the return for me. So this is what I am trying to put up. Right, this is what I am trying to put up. Whatever is the portfolio which I am talking of, it should have earned this much of return for me. So we know that dou f by dou t, half dou square this delta t. On one side, this is what we have called as the value of our portfolio. So that particular portfolio should have given me this much of return. Right? Now, let's simplify that part again. Now that we got two important relations, delta pi on one side I have got it as minus dou f by dou t minus half dou squared f by dou s squared sigma squared s squared times delta t. This is one expression that I have got. Then I have also got delta pi is r pi delta t. This is one more I have got. And we have got already the value of delta pi as minus delta f, right, or probably minus delta, or probably I could have taken the pi which is the value, we have got it as minus f plus dou f by dou s times s. Now I'll try to substitute all of them. So I'll say minus of dou f by dou t plus half dou squared f by dou s squared sigma squared s squared times delta t. This is delta pi. The same delta pi on the other side, if I take r, instead of pi, I'll take it as minus f plus dou f by dou s times s delta t. This is what I can very well take. Now I am doing a little bit of adjustment. Anyhow, I am taking out the delta t out. So I am getting, if I am taking rf to the other side, I get rf is equal to dou f by dou s rs plus dou f by dou t plus half dou squared f by dou s squared sigma squared s squared. This particular expression forms the Black-Scholes Merton differential equation. And what I am saying is this equation needs to be satisfied by almost every derivative if at all the pricing of that derivative needs to be computed. So we have used the Ito's lemma wherever possible, and based on that we found out, and we also say that the Wiener process that is underlying the value of the derivative and the underlying stock are the same. The portfolio of the stock and the derivative is constructed in this mechanism. The value of the portfolio is going to be this much. The change in the value of the portfolio, I can find it with respect to delta F as well as delta S and simplify it just like the way we have done on the sheet. And because there is no dz or delta z term, we are saying that the portfolio needs to be riskless. So the riskless means the value of the portfolio multiplied by risk-free rate of return for that time period delta t, overall resulting in matching up with this particular equation, which is called as the Black-Scholes Merton differential equation. And any function f of st, if it is a solution of the differential equation, if at all I am able to reduce it to that particular differential equation, then it becomes the theoretical price of the derivative that could be traded. So if a derivative with that price is existed, that's fine, no arbitrage opportunities. Otherwise, there is quite a good possibility of the arbitrage opportunities to be created on the same. Now let's look at one scenario before we move further. Let's say I want to talk about the forward price. Right? We know that the forward price of any security is S minus K e power minus R T minus T. So this is what I am calling as the price of the derivative. K is the delivery price. Now here I can find out dou F by dou T. Dou F by dou T for me is minus R, right? So e to the power of minus R T minus T, e to the power of minus r or minus k e to the power of minus r t minus t minus, and this minus 3 minuses are there, so there is still a minus. Similarly, if I am doing dou f by dou s, it is coming out to 1, and if I am doing dou square f by dou s squared, it's coming out to 0. Now I can very well substitute in that earlier formula dou f by dou. So now I will want to substitute dou f by dou t, which is minus r k e power minus r t minus t plus r s dou f by dou s is 1 plus half sigma squared s squared dou square f by dou s square is 0. This is becoming equal to rf. So where we are saying now minus r k e power minus r t minus t plus rs is equal to rf. R I can take out across. So f is coming out as s minus k e power minus r t minus t. Now we are able to get the differential equation satisfied, right? F is coming out equal to S minus Ke per minus RT minus T, which is equivalent to RF. And I mean, that is what is coming even from here as well. So that is where we are saying the price of the derivative is very much existing. But wherever I am not able to get that kind of a condition, then I can't do the pricing of any of these tradable derivatives in that manner. Right? That's the typical way out in terms of pricing the derivatives. Now that's one point. Any derivative which requires a pricing, I really need to see whether this differential equation for the same is going to work or not. Then, moving forward, understanding the risk neutral valuation which we have done earlier. It's an important tool for the analysis of the derivatives and the Black-Scholes Merton equation. Now, this is the interesting part. Whatever the equation we have got earlier, there is nothing to do with mu in that. Everything is talking about R. R is nothing but the risk neutral valuation, the risk-free rate of return. So the BSM equation that we have got, it has no variable that is affecting the risk preferences of the investors. No component of the expected return. No component of the risk that is involved, or not the risk involved in the security, but the specific risk preferences of the investor, where the expected return mu is going to come into picture. So if the risk preference is not there, then obviously what we are doing is a risk neutral valuation itself. So when the investors are risk neutral, the expectation of every investor, the expected return of every investor is the risk-free rate of return R itself. They don't require any kind of a premium. That is what is the characteristic of a risk neutral investor. So the present value of any kind of future cash flow that we are receiving on any kind of a payoff of the derivative, the present value is computed by simply discounting its expected value at the risk-free rate itself. So the overall analysis of the derivatives is becoming more and more simplified by making this kind of an assumption. So if at all I have to do any kind of a valuation for the derivative, the approach is very simple now. Find the expected return, which you can assume directly for that underlying asset, take it as the risk-free rate. Now, on that maturity of the derivative, find the expected payoff and discount it with the risk-free rate of return and say that that is the value of that particular derivative security. Now, we have already done this exercise for the application of the forward contract, right? We know that the forward contract is, at any point in time, the value of the forward contract is ST minus K at time period T. The value of the forward is ST minus K from the long's perspective. I want to take the expected value of this, the expected value of the payoff. I discount it to the present value. So this should be the value of the forward contract. Now what is that I can take? I'll take e power minus RT. K is a constant. So I'll take it as expected value of ST minus K. And probably otherwise I'll split it like this, K e power minus RT. Now we know that the expected value of ST in a risk neutral world is S naught into e to the power of RT minus K e power minus RT. Now these are going off, which is coming out as S naught minus K e power minus RT. So I can very well come out with the application of this same concept to the forward contract on the stock itself, which can be proved quite comfortably. Now, some of the formulas which are going as a part of the computation for Black-Scholes Merton pricing. Probably I have numerical wise I have taken it as a separate exercise. but this is the price for the call option and this is the price for the put option, where D1 and D2 are determined using this kind of formulas. And whenever I am using the n of x, it is like a cumulative probability distribution function with a standard normal distribution. So probably if I am assuming that this is the normal distribution, the area under this curve. So probably if I am saying my D1 is this one, which came through this calculation. If let's say D1 is some value here. Now ND1 is the area under this normal curve up to this particular point D1. That is why we are calling as cumulative probability distribution with a standard normal distribution. So it means that is the probability that a variable with a standard normal distribution will be less than x or D1 here. And so this is typically for European options, both for call as well as put. But we have seen earlier that in the absence of dividend, there is literally no advantage to exercise an call option, American call option earlier, which means there is no incentive for an early exercise of an American call option, which also tells us clearly that the price of the American call option should be the same as that of the European call option. But that may not be the same in case of put. So which means the Black-Scholes Merton pricing formula as it is may not be applicable relevantly to the pricing of the American put option, but definitely it will work for the American call option. And again, from the usage perspective, the interest rate R, whatever we are taking in the formula here, wherever the interest rate R is being taken, that is generally equal to the zero coupon risk-free interest rate for a maturity T. That's the practical usage of it. If I am looking at valuing a 2-year option, I'll try to look at the 2-year interest rate and based on that take the value of R. Now, just a slightly more deeper understanding of ND1 and ND2. ND2, what does it signify is it's the probability that the call option will be exercised in a risk neutral world. The probability, so if I really want to know what is the probability that the call option will be in the money, will be exercised, just by looking at ND2 I can tell that. Whereas that kind of a direct interpretation may not exist for ND1, but generally we associate ND1 to the delta of the option. But just again to understand, S0 ND1 E per RT. What we are saying is, okay, S0 is the current price. E per RT is the forward price, the expected price at the end of T period. And ND1 is talking about when the strike price, I mean, if the market price is less than the strike price, I'll take it as 0. Then I'm getting this as the expected stock price. So expected stock price, if I'm taking this, it's nothing but it's the expected stock price when all those possibilities of the stock price less than the strike price, they are taken as zeros. Then this will be the expected stock price at time T. Ignoring that so it is like the expected stock prices, expected value of the stock price, which is greater than the strike price. So from this perspective, if I am looking at the expected payoff in a risk neutral world, this is the expected value of the stock price and minus whatever is the K, which is the strike price, and the probability that the option would be exercised. So this is the expected stock price. This is the expected the strike price. So this is what will be the payoff. And because this would be the payoff at time period t, I want to find the present value, so I'll do the multiplication with e to the power of rt, makes it s naught times nd1 minus ke power minus rt times nd2. That's how the formula came up. So probably you can call this particular part as the expected value of the stock price when a stock price which is greater than the strike price itself. So that's the way we can understand ND1 as well as ND2. Then a few important properties of the Black-Scholes Merton formula. Look at from that formula, if the stock price S0 is very large, we will find that ND1 and ND2 becomes very close to 1. So the call option is very much in the money, very much certain to be exercised. So which means the price of it should be very much similar to that of a forward contract. And the same thing with the put option, it should go more and more closer to 0. So that's one way to check the worthiness of the Black-Scholes Merton formula. Make S0 to be very large compared to the strike price. I should find ND1 and ND2, both of them close to 1. And the overall should look like S minus Ke per minus RT itself, because this is ND1 is 1, ND2 is also close to 1. So it should be very much, the value should be very much closer to that of a forward contract. And in case of put, both of them are going very much closer to 0. Because n of the put option is taking n of minus d1 and n of minus d2, the value is going closer to 0. And if the volatility is 0, now let's look at this formula. Right, let's use this formula. If the volatility is 0, sigma is 0, let me assume this. This is not existing. So what is happening? D1 log S0 by K plus RT by, now sigma is 0. No volatility is existing. So the D1 is becoming literally undefined. Right? Even if I am segregating this, it is becoming almost an undefined kind of a stuff. D2 is also getting undefined. D1 minus sigma root T, sigma is 0. So probably even if I split this up, log S0 by K by sigma root T. Right now sigma is nowhere existing. So this part D1, D2s are almost going off. So ND1, ND2 are nothing. So if the volatility is not there, call option is not having any kind of a value. So which can very well be proved out through this Black-Scholes Merton formula as well. Right, if the volatility is no more applicable, if the volatility is very close to 0, I can very well see that nothing can be applied here. Even in the numerical, I can substitute volatility to be 0. But there is no meaning to the price of the call option, because either it would be exercised always or it would not be exercised at any point, because there is no volatility at all. Right? Now, so understanding the cumulative normal distribution, I have taken it separately in a different Excel sheet as a different session. Computation of the Black-Scholes Merton model. So that is where we will try to handle this. Then moving on. Warrants and employee stock options, which we have discussed in our earlier sessions as well. Whenever I talk about an exercise of a regular call option, regular which is typically on the market, it has no effect on the number of company shares. If the writer does not own the shares, he is actually buying it from the market at the regular market price and selling them to the option holder, which means it's a typical trading process itself. No new shares are getting created. But when we talk about the warrants and the ESOPs, employee stock options, it is more and more leading to the new shares being issued and then selling them to the option holder for the strike price. So here the company is involved, whereas in the traditional options that are listed on the exchange, the company is not involved in any process. And in most of the cases, the strike price will be less than the market price, because only then people are exercising the option. Otherwise, there is no incentive for them to exercise, so they will expire the option. So because the strike price is lesser, this dilutes the interest of the existing shareholders. And what it says is, if at all I want to find out by what extent it dilutes, the simple logic says the stock price is already updated with the potential dilution from all the outstanding warrants and employee stock options. Probably if I really want to know how much, what is the value of the employee stock option in relation to the traditional regular call option, right? Market based call option versus the employee stock option. If I really want to differentiate, what is the typical pricing difference between the two? So let me take a situation that the company is having n number of shares, right? The company is having n number of shares and the worth of each of the shares is some S naught. And let's say it has issued M options. Let's say it has issued M number of options. And here it has said that you can buy the share at a price K. One share is bought at a price K. So which means today the market value or market capitalization is N times S naught. Now at time period T, let's say the price is ST, which means the value is going to be NST. Now let's say the warrant or employee stock option is exercised from everyone. So there is a new money that is coming in. So people are going to buy M shares at K per share. So the new capital that is coming into the company is MK, which means the total value at that point is NST plus MK. But in that process, there are N plus M total number of shares that are created, which means the share price after the exercise should become NST plus MK by N plus M. Now, let's assume that the exercise of that option is happening at that particular point. Now, what is the payoff? So, now that the exercise is happening, the payoff for the option holder is, this is the stock price minus the strike price K. So if I simplify it, it becomes NST plus MK minus NK minus MK by N plus M. So it is coming out as N by N plus M times ST minus K. If you remember, ST minus K is the payoff of the regular call option. So what we are saying is, the price of the employee stock option or the warrant is N by N plus M times the price of a regular call option on that stock which is available on the market. So we have seen that the value of each stock option is N by N plus N times the value of the regular call option on the stock. Now the call of the total cost which the company is incurring, right? The total cost which the company is incurring for this, assuming that the company does not get any kind of a benefit out of it, the total cost that is incurring is the number of new options or the new shares that is getting created multiplied by the price of this particular option, which means, so if I am saying m times whatever is the price, n by n plus m times st minus k, this is what is going to be the cost to the company. And because of this cost, the share price is expected to go down by this much amount just because of the new issue of these options. So that's a typical way for us to make out by what extent the share price is traditionally going to fall because of the warrants and employee stock option. Right, assuming that there are no benefits from the warrant, total value of the company's equity will decline by the total cost of the option as soon as the decision to issue the warrant becomes known. So just look at this. A company with 1 million shares, today it has 1 million shares, $40. So it is thinking of issuing 200,000 shares warrants, giving the holder the right to buy one share with a strike price of 60 in 5 years. So it wants to know the cost of it. The risk-free rate of interest is 3% and the volatility is 30%. So let me look at the numbers. Right, existing shares is around 1 million. Right, existing number of shares. Warrants planned to be issued 200,000. Then we are talking of current share price, which is around 40. Then strike price, we are expecting that it is going to be sold at 60. The time period is 5 years from now. The risk-free rate of return is 3% and the volatility is 30%. Okay, so first of all, I need to use the Scholes Merton formula to find out the value of a regular option. Then I'll go with then I should go with finding out the value of the warrant, and from there I have to go with the cost of the company. So we have to do that kind of a numerical solving here. Let's go ahead and do the same. Right. So let's try solving this numerical. So from here, based on these numbers, I can first find out D1, which comes out as log S naught by X plus R plus sigma squared by 2 times T. This entire thing divided by sigma root T. Sigma is this one into square root of T. So this gives me the D1. D2 comes out as D1 minus sigma into square root of T. So sigma times square root of T is coming out to D2. D1 minus sigma square root of T. Now we require cumulative normal distribution value corresponding to D1. So I'll use norms dist corresponding to this D1, says around 48% of the area, and if I have to compute ND2 again using the same norms dist, it works out around 23% of the area. From here we know the price of the call option is the stock price times ND1 minus the present value of the strike price. So 60 by e power RT, RT. So 60 by e power RT times ND2. So the price of the call option is around 7.04. But the price of ESOP or warrant, whatever it is, right? It should be n by n plus m times. So I'm taking this as n, the total number of existing shares, divided by the existing shares plus the warrants, time the price of the call option. So which is working out to around 5.86. So this should be the price. And what we are saying is the total worth, the total cost of the warrant here is for each, from the company's perspective, under the assumption that there is no additional benefit that is coming by issuing the warrant to the company, I'm taking this price, multiply it by the number of warrants. So the total cost to the company is somewhere around this. And if this is the cost, so obviously it is going to result in reduction of the share price by this much amount. Reduction of the share price. So this is the cost which will reduce the share price split across the existing shares. So which is talking about around $1.17 reduction in the price. So the price is already reflecting final share price post the warrant is directly coming out as the current share price minus the reduction, working out to around 38.82. So that is what is traditionally working out. 38.83 is what we are calling as the final price of the share because of the issue of the warrant. That's the way we evaluate the stuff. Alright. Next, we try to understand the next important concept, which is volatility. If you look at all the inputs which have gone into this Black-Scholes formula, the current price I know, strike price, the price at which I want to buy or sell in future, it is decided by me. The time to expiration is known, R is known. The only uncertainty in this formula is sigma. So it can't be directly observed. So you have to estimate it from a history of stock prices. So when you are estimating it, we call that as the historical volatility. In some cases, instead of observing it from the historical stock prices and estimating it, we prefer deriving it from the corresponding Black-Scholes model. So it is implied by the option prices observed in the market. Now what I mean by that is, let's say I am observing this option price in the market and the price of this option, let's say, is $10, not 7.04. Right, in the market, this option is available for 10. Then I am trying out the different values of sigma, which will make the price of this, the theoretical Black-Scholes model price of this option, equal to the market price. That is what we are calling as the implied volatility. For example, I change the sigma here. For example, I change the sigma of the option, let's say to 32%. Now my call option price is becoming 7.75. I change it to 35%. It's becoming 8.82. I want that particular sigma which will make the price of the call option around 10. Now when I made it 40, it became 10.6. So probably if I am keeping it 39, it's still at 10.24. Now one way is I can adjust it through my what if analysis, where I can use goal seek, where I'll set the value of this particular cell to be equal to 10 by changing this cell. So this is around 38. Probably if I want it much more appropriate, if the sigma is around 38.31, the price of the call option is going to be around 10. Now this part is what we call as the implied volatility. We are doing an iterative search procedure by changing the volatility in the Black-Scholes formula and trying to match the Black-Scholes price of the call option with the market price. And whatever the volatility that is fitting there is what we are calling as the implied volatility. So not just Black-Scholes, I can use any kind of a formula. Either I can use it as a part of the binomial tree approach as well, if I am going for implied volatility for an American option. Even in the binomial tree model, we said that the up movement is e power sigma root t, and the down movement we are going to take e power minus sigma root t. Now I can change the sigma. For what value of sigma the price would be matching the market price of the option. That is what could give me the implied volatility. The volatility that is implied from the market prices. So the major intention of relying on implied volatility is I am monitoring the market's opinion about the volatility. So majority of the times, if you look at the historical, I am collecting the past data, and based on that I am arriving some estimate of the volatility, which is more and more a backward looking approach because I am using the past data to compute the volatility. Whereas implied volatility is based on the current price of the option, which is a reflection of the future movement of the stock. So the implied volatility becomes more and more forward looking, whereas the historical volatility is more of a backward looking kind of an approach. And what we also see is the implied volatility is less volatile compared to that of the option price. So there is a lot of time the traders talk in terms of implied volatility. Implied volatility of the actively traded options are used by the traders to estimate appropriate implied volatilities for other. So I'll use the implied volatility of the most actively traded option, and that implied volatility is used for pricing other option. Right? Probably if the at the money option is having a very large volume, very large number of open positions, then I find the implied volatility using the at the money option. Whatever the implied volatility I get here, I use it as a volatility into the Black-Scholes model for pricing the other option. That's the way we do it as an appropriate pricing of the option. Then, just to understand the volatility index, VIX, it is published by CBOE, which is a measure of the implied volatility. So it is publishing the index of the implied volatilities of the 30-day options on the S&P 500, which is calculated based on different calls and puts that are on the S&P 500 index. And in general, it is even called as the fear factor because this is the one that indicates where the direction of the movement of the stocks in the future is going. Is it going to be more volatile or less volatile in the future? And finally, I would also talk a little bit about the dividend. We always can assume that if I am talking about a life of our option, if it is for a very short period, I can very comfortably predict the dividend amount that can be received on that particular stock. But what this model assumes is, if we assume that whatever is the life of the option, it is short, or whether it is short or not, during this life of the option, the amount and timing of the dividend I can comfortably predict. So there is a certainty to my prediction, which probably is more apt for short term, but may not be for the longer term. Now, we know a definition of an ex-dividend date, which is the date on which the stock will start trading without the dividend, which means the stock price declines by that much of dividend that is going to be declared. So what we say is, when a dividend is given, or when I am expecting some dividend, okay, this is the stock price today, this is the expiry of the option, I am expecting that the dividends are going to be declared here and here during the life of the option. Now, what we are saying is the amount and timing of this are reasonably known. Right? Now, the stock price at any point, we are talking of two parts. One, the dividend, it's a present value of the dividends, along with the fluctuation in the price of the share. So for the dividend, which is the riskless part, because I'm making an assumption that I know the amount and the timing of the dividend. So I discount them to the present value using the risk-free rate. Right? I discount them to the present value using the risk-free rate. So by the time I come to this date, obviously the dividends are already paid. So there is no riskless component there. So the stock price, whatever is reduced by the present value of the dividend, which we do even for the option, even for the forward pricing as well. The stock price minus the present value of the future dividend, that is what I am calling as the adjusted stock price. And that adjusted stock price is being taken as input into the Black-Scholes model for doing the pricing with respect to when there are dividends that are declared. But using this approach, there are quite a few arguments that are running around. The volatility that we are taking, it should be applied to the stock price, not to the adjusted stock price. But we are taking the volatility with respect to the adjusted stocks price. So that is where some level of argument comes up. But what we are trying to say is, if any analyst is using the same model, especially for computing the volatility as well as applying it, implying and applying, let's say the same volatility is used, then there is nothing of model dependency that we are bringing into the computation of the price of the option. And if I have to apply the same logic to the Americans, anyhow, if the dividend is there only just before, if the dividend does not exist, obviously there is no motivation to exercise the American option earlier. That we have discussed in a quite a good number of occasions earlier. But if there are any dividend, what is said is it is very much optimal to exercise the option just before the stock goes ex-dividend. That is the latest possible date before the stock goes ex-dividend. So that's a traditional way we do the valuation, especially for American options where the dividends are possible. So that's what we would like to conclude this session. So we have discussed comfortably on the log-normal property of the stock prices, the distribution of the rate of return, where we talked about the normal distribution, right? We talked about the expected returns, what are the factors that influence this, the volatility. Then we got into the Black-Scholes Merton differential equation, the basic idea behind it as well as the derivation of the same. The risk neutral valuation, how is it linked with respect to the Black-Scholes Merton's formula? The pricing formula for Black-Scholes Merton equation. Then we talked about what do you mean by ND1 and ND2 as a part of the Black-Scholes equation. How do I differentiate the traditional stocks and bonds, traditional options on the stocks which are listed on the exchange versus the warrants and employee stock options. And towards the end, we spend some time in terms of discussing the implied volatilities and what if dividends are present, dividends are given on a stock, how do I use that information to price the value of European as well as American call and put option. So this is what I would like to talk about as a part of this session. Thank you very much.